Oil marketing companies IOC, HPCL and BPCL have all reported their earnings for Q4, while for IOC, strong marketing margins as well as GRMs were in line with expectations. BPCL reported a miss on revenue estimates, but the other numbers were largely in line with estimates. And while HPCL recorded a 70% jump in its net profit, the slight miss on the refining was more than offset by beat in the marketing segment. Let's do a three-point analysis of the earnings of these OMCs as well as where our top brokerage houses placing their bets now. 1. How are the earnings of IOC? Well, IOC has reported a 17% year-on-year rise in the fourth quarter profit on foreign exchange gains, as well as profits rose to over 6,000 crores. Now, there was a foreign exchange gain of 837 crores in Q4. Gross refining margins, although in line with estimates, fell to a little over $4 per barrel from $9 per barrel a year ago. Now, the company also made an inventory gain of over 2,600 crores in Q4. Leading to margin improvement as well. Now, it also retained its market share in most product categories, as well as the concerns over geopolitical tensions rising in the Middle East, the risk of rising crude oil prices, and thereby the chances of subsidy burden on OMCs continue to loom large right now. The increase in debt burden is a key concern as high dividend payouts and large capex will continue to impact cash generation as well. Now, top brokerages believe that the valuations are reasonable, but higher debt burden could hinder re-rating from here. Motilal Oswal has a buy rating on IOC with a target price of 198, while Yes Securities says hold with a target price of 142 rupees. 2. How are the Q4 earnings of BPCL? Well, BPCL reported a slight miss in Q4 revenues, but its operating profit shot up to over 4,800 crore rupees versus 778 crores sequentially. Now, it also recorded a 16% jump in net profit to over 3,100 crore rupees. Core GRM stood at $2.6 per barrel. Inventory gains and rupee appreciation negated the dip in GRMs as well. Now, marketing margin inclusive on inventory gain was at an all-time high. Now, the marketing margin also stood at 6.3 rupees per litre. BPCL's Kochi refinery performance has not lived up to the promises, with GRMs consistently below the benchmarks, and this could definitely weigh on the stock going forward. Now, Motilal Oswal has recommended a buy on BPCL with a target price of 452 rupees. Citi also has a buy rating with a target price of 420 rupees per share, while Yes Securities sees a downside from current levels, says hold with a target of 358. CLSA has a sell rating on the stock with a target price of 300 rupees. 3. How did HPCL perform in March quarter? HPCL reported a better than expected performance in Q4 with a EBITDA at 5,200 crore rupees and a profit after tax of 3,000 crore rupees. Now, foreign exchange gains of 250 crore rupees also helped the company report better than expected profits. Now, GRMs for the quarter were at $4.5 versus $7.1 per barrel in Q4 FY18. Now, marketing segment performance was definitely ahead of estimates, with crude oil prices on a firm trajectory on the back of rising geopolitical tensions in the Middle East and risks of subsidy burden on OMCs has been rising. HPCL, with the most adverse refining to marketing mix, is the most levered to gyrations in the marketing margins as well. Now, on the other hand, we expect global GRMs to see strength as the new IMO fuel regulations also are implemented. Now, the stock adequately also prices the current volatile environment and trades at a discount to IOC and BPCL. Motilal Oswal has a neutral rating on this stock with a target of 309. Citi has a buy rating with a target of 310. Yes Securities has assigned a hold rating with a 1-year target price of 275 rupees, while CLSA maintains a sell rating on the stock, gives a target of 210.